we're going to do is we're going to be monitoring this top. There's your 1343 half bar right there. As we close out February, we're going to see if we can get a closing monthly bar above here. Everything on this chart is extremely bullish for the bulls. There's nothing that says that the way that the public will read it and understand it, it is, because the truth is here. However, you can only go so far in the short term coming. We're going to see if we start to get sell distributions next week because we're too overbought. And the thing about it is, when you're too overbought, it's time for the bigger money to ring the cash register into the move. They have to have someone to sell to. Who do the big institutional people sell to? They sell to people that are still wanting to chase that performance. They can't unload all the positions at one time, but as we continually go up in toward the top, they're going to be selling. That's going to be a little bit of an overhang on the broader part of the S&P 500. S&P 500 earnings are winding down. Great report card. They did well in the cycle. However, we've had an 8-quarterly cycle in the S&P earnings. And the thing about it is we're going to hit a top on those earnings because what's going to happen is they've been going outside of the U.S. to get their performance in other countries around the world in the SMF global trade. And it's been on the tape for the last couple of years. And the thing about it is once all the money is in and all the bulls are in and there's very little bears, that's when you start to see the retracements in indexes and in individual stocks. I have been doing this for 30 years. I have never seen an index stay at 90.51% on a monthly level. You can go to a point of no return up to maybe 92.5 here, 93, but you won't stay up there. That means that the call side of the market and the option side of the market is all the way up toward the top, and the deflated put side of the market within those put options in the S&P are totally deflated in value. And when you get too inflated in value, well, they have to come down like they always do. They can end up quite ugly for the bull at times, like they always have and always do. So basically, we're going to be monitoring what that March Madness is going to be and how we close out February. We're going to be taking a look on the fact that the flash trades, which accounts for about 60 to 70% of the volume in the broader markets, is there was a little absentee last week because I couldn't arbitrate it. And that's part of the bigger side of this tape is it's a professional money tape. And the broader volume within the broader market and the S&P 500 index is, quote, quote, supposedly the professional community money that's been coming off the sideline, and the train has left the station, and the wall of worry, you climb higher until you finally climax, and then the bear and the media are going to come in and start doing their thing as we go into March. Now, having said that, March is a time where markets perform extremely well because you've got totally the different move. When we go back and we take a look at other time periods, such as over here, this is what I'm talking about. In 2010, we had a little bit of a sell-off, then we rallied up into that March Madness right here. Yes, we did. You don't want to believe it? We were here. Look at there. 2-1, we started to come up. Here, 3-1, we rallied, and we rallied right on up until 4-1. And then we had that big double month reversal in 5-1, and we finally put a bottom in 6-1, and we consolidated these bottoms, and the uptrend on the S&P started at 9-1. Nobody ever thought that that could ever happen except us, because we couldn't break the bottom, and we took up a half of that bar right here. We knew you had to get long. How far it would go, we wouldn't care. We'll let the public tape be the decipher and the opinionators to tell us and guide us how far it would. Since then, we had a narrow distribution right here in 11.1 toward the end of 2010. But when we started to close above that doji, monthly doji, and we started to go up higher, you can see on a monthly level here that this is where we're at. Now, it's quite different than the previous year of 2010. So basically, it's a great time to sell in to the market, to sell in, to take a round of profits, because everybody will be expecting the same thing as they always do, and that's time to sell. On the next video for our bigger traders worldwide, we're going to do where the S&P 500 put options below the market and the kind of volume and the big bearish bets that have come into the S&P 500. And basically, this is a major concern for the bull as far as I'm concerned. We just take for what it's willing to give. We don't have an opinion, but we do know that our experience tells us that there's going to be some pullbacks and there's going to be a time to take some profits. And the new MMTs are going to find the most overbought stocks in the S&P. There's about 5 good ones there that can really make a lot of money. And when the end, we're going to use put options at the right time. Right now, the bear has been squeezed all the way up. Too bad for the bear. But their day will come. The momentum is in that monthly buy signal. And as long as we stay in the monthly buy signal, that means that your pullbacks are going to be buyable. That means that people that haven't chased the performance will come in on the buy side of the S&P 500 and continue to chase that performance. You've got the commodity markets around the world re-leveraging to the upside. But guess what? Let us not see another 2007 high oil and high commodity prices. That's the perfect recipe where the bigger bull community is going to start to change their mind very rapidly when we get to that stage. However, we've been re-levering up because that's been part of the growth story. Okay? But it kills and chokes off the American consumer at some point between now and June of 2011. You've been given a gift, Tommy Two-Tone.